All right, let's talk about something that trips up so many people every single year, the surprise tax bill. It's that jaw-dropping moment when you think you've had an amazing year, financially speaking, only to get a notice from the IRS that tells a very, very different story. Picture this. Your company's stock is flying high. You've finally exercised those stock options you've been sitting on, and you're feeling like you've made it. Then tax season hits, and bam, you're staring at a tax bill that makes absolutely no sense. It's for an amount of money that you never even saw in your bank account. If that sounds even vaguely familiar, you are not alone. And we're about to unpack exactly why that happens.
To get to the bottom of this mystery, we have to start where the IRS starts. And their starting point is this simple, but honestly, massive assumption. Pretty much anything of value you receive is income. Let's look at a few examples that might blow your mind.
So, let's say you're a graphic designer and you trade a logo design for a plumber to fix your leaky faucet. No cash ever changes hands, right? Well, wrong. According to the IRS, you both just earned income equal to the fair market value of whatever service you got. And get this, you're walking on the beach, you find a pirate chest full of gold? Just kidding, but seriously, IRS publication 525 calls it a treasure trove. If you find and keep something valuable that was abandoned, it's taxable income in the first year you get your hands on it. No joke.
Okay, this one's probably a little more familiar, but it's a perfect example of the IRS mindset. Whether it's a winning lottery ticket, a lucky night at poker, or your fantasy football league, those winnings are income and you've got to report them.
So here it is, the golden rule of taxes, straight from the source. The default setting is taxable. You have to assume everything counts as income unless you can find a specific law that says, no, not this time. This mindset is what really sets the stage for our main event.
So how does this everything is income idea lead to that massive, unexpected tax bill? Well, it all comes down to one of the most common and most confusing culprits out there: incentive stock options, or ISOs. Look, when you get stock options, there's kind of this four-step journey. First, the company grants you the options, then over time they vest, which just means you've earned the right to actually use them. Then comes the big moment. You exercise them, which is when you buy the shares at your special locked-in price. And finally, you might sell them. Now that third step, exercise, whoa, that's where the tax trap is waiting. And here's why. Let's say your special strike price is just $1 a share, but on the day you exercise, the stock is trading on the open market for $6 a share. That $5 difference is what we call the spread. And here's the crazy part. You haven't sold a thing. There is no new cash in your bank account. But in the world of taxes, you've just created a $5 paper gain for every single share. Let's put some real numbers on this. Meet Wendy. She exercises 20,000 options. With that $5 spread we just talked about, she has, boom, just like that, created a $100,000 paper gain. Again, this money is not in her wallet. It's just the theoretical value locked up in her stock. But in the eyes of the tax system, that $100,000 is very, very real. So that's the big question, right? If this $100,000 of phantom money doesn't show up on your W-2 like your normal salary, how in the world does the IRS even know about it, and how do they tax you on it? The answer lies in a parallel universe of taxes. To really wrap your head around this, we need an analogy. You know Uncle Sam, right? Represents the regular U.S. tax system. Well, to understand this tax trap, it's time for you to meet his lesser-known and much, much stricter relative, Auntie Samantha. Just think of it like this. Every year, Uncle Sam and Auntie Samantha both calculate your taxes, but they use totally different rule books. Uncle Sam, he cuts you some slack. He lets you take common deductions, and for regular tax purposes, he totally ignores that stock option spread. But Auntie Samantha, she plays by a different set of rules. She says no to a lot of those deductions, and, this is the big one, she adds that entire $100,000 spread right back into your income calculation. And this whole Auntie Samantha system, well, that's the alternative minimum tax, the AMT. It's literally a parallel tax system running in the background for everyone. It was designed to make sure that people with high economic income, like Wendy with her huge paper gain, pay at least some tax. And the rule is brutally simple. You calculate your tax bill both ways, and you have to pay whichever one is higher. Okay, so you think you've got it, right? Uncle Sam, Auntie Samantha, you pay the higher of the two. But hold on, because it gets even trickier. There's a hidden trap inside the AMT system itself, and it can catch a lot of people by surprise. See, the AMT system is supposed to give you this little buffer, a head start. It's called an exemption.
For 2025, it's about 88 grand for a single person. Think of it as an amount of your income that Auntie Samantha just agrees to ignore. But here's the catch. That buffer doesn't last forever.
Because the moment your income, according to Auntie Samantha's strict rules, hits this number, about $626,000, that safety net starts to get yanked away. For every $4 you earn above this line, you lose $1 of that protective exemption.
And this is the real kicker. This is the trap. The official AMT tax rates are 26 and 28%. But because you're losing that exemption at the same time you're earning more money, your effective tax rate, what you're actually paying on each extra dollar in that zone, can skyrocket to a shocking 35%.
All right, I know that was a lot, and it sounds pretty scary. But here's the good news. You are not stuck. This is not a hopeless situation. Understanding the trap is the first step. The next step is having a strategy.
So how do you play this game smarter? Well, you've got a few power-ups. One, you can exercise early in the year. That gives you more time to see what your finances look like and adjust. You could also break up a large exercise into smaller chunks across different years to stay under those key income levels. You can try to exercise when the spread is small, maybe if the stock price has dipped. That creates a smaller paper gain. You can also plan other income events, like selling other investments, to make sure you stay below that nasty 35% phase-out zone. Now, the last two are a bit more advanced. A disqualifying disposition means selling the stock in the same year you exercise it, which can sometimes get you out of the AMT system entirely. And finally, if you do get hit with the AMT, you might earn an AMT credit that you can use to lower your regular taxes in future years. The key to all of this is planning.
Look, the takeaway here isn't that you need to become a tax accountant overnight. Not at all. The goal is to become an informed planner, to know that these landmines are out there, and to know when you need to run some scenarios or call a professional before you pull the trigger on a big financial decision.
At the end of the day, your financial future, it's a story that you get to write. And a surprise tax bill is just a plot twist you didn't see coming. By knowing these rules, you're taking back the pen. So my question to you is, are you planning your next chapter?